Imagine for a second that you own, say, a classic car.
Okay.
You bought it a decade ago as a project, maybe for 20 grand. It's in the garage, you polish it, you love it, you're not selling it.
It's just yours.
Right. But then, this year, the market for those cars just goes completely bananas. And suddenly, your car is worth 100 grand.
So on paper, you're $80,000 richer. Congratulations.
Exactly. On paper, I haven't sold the car. I don't have $80,000 in my pocket. I just have the same car. But then there's a knock on the door. It's the government.
Oh.
And they say, hey, we noticed your car's worth a lot more. We'd like 36% of that increase, please, in cash, right now.
And if you tell them, but I haven't sold it, I don't have the cash, well, under the system we're talking about today, that's just not an excuse anymore.
Exactly. Welcome to the deep dive. Today, we are looking at a presentation that is, frankly, going to keep you up at night if you have investments.
And doubly so if you're an expat living abroad.
We're unpacking a presentation by John Richardson, dated today, February 18th, 2026. It's titled, Deemed Income in the Netherlands.
And I want to be really clear here. The title says Netherlands, but don't tune out if you don't live there. Richardson is using the Netherlands as a case study for a huge global shift.
What kind of shift?
We are moving from a world where you're taxed on what you earn or what you sell to a world where you're taxed on what you simply have.
So our mission for this deep dive is to really get our heads around that. We're going to look at how these tax systems built for, the industrial age are just crashing into our digital age.
And that's leading governments to hunt for new ways to get money out of taxpayers.
Specifically, we're going to look at the absolute nightmare this creates for U.S. citizens living in places like the Netherlands.
It truly is a nightmare scenario for them. But the so what for everyone else is that this is a redefinition of property rights. As Richardson points out, we are fast approaching a reality where you might have to borrow money just to pay tax on assets you already own.
Okay, so let's unpack this. The source starts with a really heavy prologue. Richardson writes, as goes taxation, so goes civilization. That feels a little dramatic for a tax presentation, doesn't it?
It does sound dramatic, but if you look at history, it's pretty accurate.
Yeah.
I mean, taxation is kind of the operating system for a society. It decides who has power, who has resources.
And Richardson's argument is that our old operating system is broken.
It's broken.
Yeah.
It was designed for the industrial age. Back then, wealth was physical. It was factories, land, machinery. It was heavy. You couldn't just move it.
Right. The government knew where your stuff was, but now we're in the digital age.
Exactly. Capital is mobile.
I can move $1 million from New York to Singapore with a scan of my face on my phone.
Right. And that mobility, it terrifies governments. The source calls this era hunt for more taxpayers and for more income. They're panicked. They see the wealth slipping through their fingers, so they're changing the rules of the game.
Okay, let's talk about those new rules. The big shift is from realization to deemed realization. Can you break that down for us?
Sure. The traditional standard, the old industrial age way, is realization. Let's go back to your car. You bought it for $20,000, it's now worth $100,000. You have a gain, but it's unrealized. You don't pay any tax until you actually sell the car and realize that $80,000 profit.
Which makes sense. That's when I actually have the money to pay the tax.
Precisely. It's fair. It respects liquidity. But Richardson argues that era is ending. Governments are moving to deemed realization.
Being deemed.
Yeah. This is where the government looks at your assets at the end of the year, sees the value went up, and deems that you made money. They just pretend you sold it.
So they tax you on the growth, whether you touched it or not.
Exactly. On the accretion of wealth.
And Richardson uses some pretty intense jargon to describe this. He uses terms like PFICization and subpartism.
Yeah, subpartism sounds like a disease. Like, I'm sorry, the test came back. You have a bad case of subpartism.
Is it terminal?
Financially, you can feel like it. Subpart F is actually part of the U.S. tax code. It was designed to stop people from hiding money in offshore shell companies.
Okay.
So if you had a company in the Caymans making money, the U.S. would deem that income to be yours personally right now, even if the company never paid you.
They just reach through the company to get their cut immediately.
Exactly. But Richardson's point is that this mechanism, ignoring the legal reality to get the tax revenue, is becoming the new normal for everything.
It's not just for offshore tax dodgers anymore.
No. The world is moving toward what he calls ending deferral. Governments are just tired of waiting for you to sell your assets. They want their cut every single year.
And the source doesn't mince words. Richardson calls this confiscation of wealth.
He does. He puts it in the same category as exit taxes and wealth taxes. Because whether they take a chunk of your net worth directly or tax you on deemed income that isn't cash, the result is the same.
They're taking a piece of your actual asset base year after year, which brings us to the laboratory where this is all happening at full speed, the Netherlands.
Right. The source details their policy known as Box 3.
So what's actually happening there?
The Netherlands has effectively moved to a system where they tax your investment assets based on a deemed return. For 2026, the presentation shows a tax rate of 36% on that deemed gain.
Okay, let's just pause on that. 36% on the increase in value.
Correct. So if your stock portfolio goes up by $10,000 in a year, you owe the Dutch tax authority $3,600.
But I haven't sold any stocks. They're just sitting there. I don't have that $3,600.
And that leads to the critical question in the presentation. Where does the money come from to pay the tax?
Right. If your wealth is tied up in a house or a family business, you just don't have the cash.
It seems like a recipe for forced liquidation. You'd have to sell the asset just to pay the tax on it.
Or you go into debt. And this is where it gets a little dystopian. Richardson shares this story from the 1980s. A law professor told him, soon they will be requiring us to borrow money to pay them taxes.
Which back in the 80s must have sounded like a wild conspiracy theory.
Totally. Science fiction.
But with this Dutch 36% tax on unrealized gains, that prophecy is literally coming true. If you have a high-growth asset but no cash flow, you might have to take out a loan against your asset just to pay the tax on its growth.
It fundamentally changes what it means to own something. It's like you're renting your own wealth from the government.
It really shifts the dynamic.
Right.
It's less I own this and more I am the custodian of this property as long as I can pay the annual tax bill on it.
Okay, now, if you think that's bad, let's get to the expat trap. This is the nightmare for U.S. citizens in the Netherlands.
Because the U.S. is one of the only countries that taxes you based on citizenship, not just where you live.
So a U.S. citizen in Amsterdam is caught between two completely different tax worlds.
Exactly. They have the U.S. system on one shoulder and the Dutch system on the other. And the U.S. system, for the most part, still taxes realization.
When you sell.
When you sell.
Mm-hmm.
But the Dutch system now taxes deemed gains, the annual increase. So the timing is completely off.
One wants money now, the other wants money later, and that creates a massive treaty gap.
Right. The tax treaties are supposed to prevent double taxation. You pay tax to the Netherlands, you get a foreign tax credit on your U.S. taxes. Simple.
But that assumes the taxes are for the same thing at the same time.
Right. So let's play this out. I'm in Amsterdam. My stocks go up. The Dutch send me a bill for 36% of the gain. I pay it.
Okay.
Now I go to file my U.S. taxes. I say, hey, IRS, look at this tax I paid in the Netherlands. Give me a credit.
And the IRS looks at your return and says,
They say, what are you talking about? You didn't sell any stocks. On your U.S. return, you have zero income. We can't give you a credit against zero tax.
So the credit is just denied. I've paid the Dutch and I get nothing for it from the U.S.
Right. You can carry that credit forward maybe for 10 years, but then say 5 years later, you finally sell the stock.
Now I have a realized gain for the U.S. The IRS says, great, time to pay U.S. tax.
And you say, wait, I paid the Dutch tax on this growth years ago. Let me use those credits I've been saving up.
But can I?
Maybe, maybe not. The mismatch in timing makes it incredibly messy. Richardson even points out that the Canada-U.S. treaty suggests in similar situations, the answer is often just tough luck.
So you could genuinely be taxed on the same money twice.
Yes, you could pay 36% to the Dutch as it grows and then pay 20% or more to the U.S. when you sell. You're looking at an effective tax rate of, 60, 70%? It just destroys the whole point of investing.
It's wealth destruction. Richardson calls it paying to leave but paying more to stay. You're just trapped.
Trapped in the friction between two systems that don't speak the same language.
Is there any way out? He does offer a potential workaround, but it sounds incredibly complicated. He calls it the PFIC strategy.
Yeah, you know things are bad when the solution involves PFICs. Usually when we say PFIC, passive foreign investment company, we're telling you to run for the hills.
Right. They're usually radioactive, for mutual funds, punitive taxes, insane paperwork. So why is he even suggesting them?
It's kind of a hair of the dog approach.
Yeah.
He suggests looking at what's called the mark-to-market election, Section 1296 of the U.S. Tax Code.
Okay, mark-to-market. What does that do for me here?
Well, if you make this election, you are voluntarily telling the IRS, I agree to pretend I sold this investment at the end of every year.
You're forcing the U.S. system to act like the Dutch system.
Exactly.
So you're voluntarily triggering U.S. taxes on gains you haven't realized. That sounds completely insane. Why would anyone do that?
To synchronize the clocks. If you force the U.S. tax event and the Dutch tax event to happen in the same year, then theoretically the foreign tax credit should work.
Because now you have U.S. income and you have Dutch tax. They line up.
They line up, but you said the key word, theoretically. Richardson puts a huge warning label on this strategy.
Yeah.
He writes, and I'm quoting, "I am not certain that the credit is available, even if you do this."
Wait, why not? If I align the timing, what's the problem?
It gets really technical, but the IRS has these things called baskets of income and sourcing rules. They might argue that because this is a deemed gain and not a real sale or a dividend, it doesn't count as foreign-sourced income.
And if it's not foreign sourced?
You can't use a foreign tax credit against it.
Wow. So it's a huge gamble. You could go through all the complexity, buy a product you'd normally avoid, voluntarily increase your U.S. taxes, and the IRS could still say, nope, no credit.
It's possible. And that's what's so terrifying about this source. Here we have one of the top experts in the field, and his answer to the most critical question is, I don't know.
It really just shows how the legal system hasn't caught up to this new reality.
Not at all. The taxpayers are the beta testers, and the bugs are very, very expensive.
But this is where the deep dive takes a turn I really didn't expect. After all this dense, technical tax stuff, Richardson pivots to philosophy.
It is surprising, isn't it? Part C is called a new definition of wealth, and it has nothing to do with maximizing returns.
No. His first point of defense is the best defense is to be happy with little.
It's almost stoic. He's saying if the system is designed to punish and confiscate complexity, then the only way to win is to opt out of that game.
He says simplicity is virtue.
Right.
And I found it pretty funny that he, a lawyer, explicitly writes, accountants and lawyers are your enemies.
That's a striking admission. But think about it. If your financial life is so complicated that you need a team of expensive experts just to keep you from going broke from taxes, have you really won?
You're just working to pay them.
You're working for the system.
He also says, invest only in what you understand. And deferral may be very costly down the road.
That point on deferral is huge. For decades, the mantra was defer, defer, defer. Pay taxes later. But Richardson is saying that in this new world of deemed income, deferral is a trap.
Because it just builds a bigger pile for them to tax every year?
Exactly. You're just building up a bigger target. His advice now is almost to realize gains, pay the tax, and move on.
The ultimate advice he gives is this. Time is the true currency of life. The goal isn't just to be rich, it's to escape the complexity so you're not spending your whole life thinking about taxes.
It's a profound way to end a tax presentation.
Yeah.
He's saying the administrative burden of being a wealthy global citizen is so high now that it literally eats your life.
If you spend 10 hours a week on tax compliance, that's 10 hours of your life you've lost forever. No tax saving buys that back. So the winning move in 2026 might just be to own a boring index fund, live simply, and avoid anything that requires a fancy lawyer.
Simplicity is the ultimate shield.
All right, let's recap this journey. We started with the breakdown of these old industrial age tax systems and the desperate hunt by governments for revenue.
Which led us to the rise of deemed income, taxing you on the growth of your assets, not the sale. We saw it in action with that Dutch 36% tax.
A tax that asks you to pay cash for paper profits. And we looked at the specific hellscape this creates for U.S. citizens in the Netherlands.
Caught between two systems, facing a double tax threat with no clear solution.
We even looked at that risky mark-to-market fix and how even the experts aren't sure it works.
And we ended on a philosophical solution. Radical simplicity. Be happy with little and understand that complexity is now the enemy.
It's a stark warning. The definition of ownership is changing.
It is.
So here's the final thought I want to leave you with. We all grew up thinking of wealth as an asset, right? Something that gives us freedom, solves problems. But based on what we read today, we're moving toward a world where you're taxed on what you have, regardless of your ability to pay.
So it raises the question, if you own an asset that grows, but the tax on that growth forces you into debt or forces you to hire a team of lawyers just to defend it, is that wealth still an asset?
Or has the modern accumulation of wealth become a liability?
That is the question to ask yourself.
Something to mull over. Thanks for listening to The Deep Dive. We'll see you next time.